to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Wednesday, the 3rd of September 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future and likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so today we have much ground to cover because given yesterday highly volatile movement across the global markets. But before I jump straight into the short-term intraday technical outlook charts, I believe that most of you guys are eager to find out what are the key levels to look out for today. Let's have a quick recap what has taken shape yesterday in terms of economic news flow, economic data, as well as their impact on their respective relevant intraday movement of the broad-based cross asset classes, and as well as key data that has taken shape or that has released at the start of before the start of today's daily dose at 11 a.m. Singapore time. So very quickly, yesterday's big movement came in actually the bond market itself. So what happened yesterday over here was this. Okay, let me immediately go to that. All right. So yesterday, the catalyst, right, that saw this sharp movement on the FX market and global stock indices was due to the spike up in the 30-year UK sovereign bond yield to a level not seen since 1998. So yesterday, the 30-year gilt, they call it the gilt, US Treasury is the US sovereign bond. So a UK sovereign bond, they call it gilt. So the 30-year gilt actually spiked up to 1998. So why is it so significant? So if you look at the chart of the 30-year gilt over here, so very quickly, let me go to this chart. All right, over here, let me expand. Okay, where is it? Yeah, this is the one. Okay, so this is the 30-year UK gilt. So what we could see, if you were to look at the 1-month chart, it spiked up to a level not seen March 1998. So that is actually a 27-year high. So we know that 30-year is actually a 30-year sovereign bond yield globally is being used as a benchmark for longer term interest rates. Like for example, your longer term loan, the 30-year housing loan, in some form also corporate loans as well, where corporates wants to actually issue longer term bonds. So they use this 30-year sovereign any sovereign bond 30 year as a benchmark. This is kind of a risk-free rate. Then from there, they will add on various risk premium. So being that the most risk-free rate, long-term risk-free rate has starts to actually spike up, it means that potentially there could be a higher chance that longer term interest rate globally will start to rise as well. So that could potentially have a liquidity squeeze and create a profit margin compression in corporation, those corporation that has a high gearing, and that actually causes a negative feedback loop into the global stock market yesterday. All right, so later I'll touch on the global stock market perspective. So this spike up in the 30-year gilt, means the UK sovereign bond, is not caused by what I call an improvement in economic growth in UK. Because we know that longer term sovereign bonds also move in sync with economic growth. That means if economic growth improve, there'll be more spending by consumer, there'll be more business investment from corporation. Eventually, they will push up longer term yields. But these longer term yields in being pushed up in the 30-year gilt is actually caused by market not confident in the UK government in controlling their budget deficits. All right, so what do I mean by this? So if you look at it over here, okay, UK market suffer a fresh sell-off with yield on longer dated bonds hitting the highest since 1998 and the pound tumbling as pressure mounted on Prime Minister's stammer to win the confidence of investors in the government budget. So this government budget over here, at this moment in time, because the last budget was rather a loose budget over here. That means a loose fiscal policy, where they actually we call it, how I put it away, they they actually do a much more of kind of a welfare budget, and because of this welfare kind of budget, they actually widen the UK budget deficits. So being widen this UK budget deficits, investors lose confidence in the government in controlling this widening of these budget deficits. And uh, the current, we call it finance minister, which UK they call it Chancellor Reeves, is due to deliver a budget before the end of this year, and is scrubbing to find savings or rise taxes to plug a budget hole without depressing economic growth. So right now, UK is facing this widening budget deficits. So if this widening budget deficit continues to remain uncontrolled, that causes investors to lose confidence in the UK government in funding these budget deficits, and therefore demand higher risk premium to own UK sovereign bonds, also thereby pushing up the 30-year UK sovereign bond yield, which is the gilt over here. So being that also causes the pound to actually sell off as well against the dollar. So what you could see in the FX market over here, yesterday, we see the dollar strengthening against the pound very strongly, almost 1%, positive 1%. This is a 5-day. Pardon me. Give me a minute. Let me change this setting. So this is the 5-day rolling performance. All right, a 5-day rolling performance of the dollar against the major currency. So as you could see on my screen here, the dollar actually spiked up yesterday, almost all against all the major currency. The strongest is against the pound and against the Japanese yen, which is up by 1.10% as we are speaking right now. And the sterling, the dollar is up against the sterling by almost 0.97%, which is 1%. Okay, so the funny thing about FX market is they are very, very volatile. They react very volatile. They react accordingly to various factors that is impacting the markets. So from the short-term nature over here, we see a spike up in the dollar because of markets not confident in the UK government in servicing their or taking steps to actually address their widening budget deficits. In turn, investors losing confidence in owning longer-term UK sovereign bond. All right, that causes the 30-year gilt to actually spike up to a level not seen since 1998, and that also creating a cascading impact on the FX market. But what you could see over here is that if you look at other factors that impact the FX market movement, which is looking at the 2-year US Treasury yield minus the 2-year spread versus the rest of the world. So what I did over here is that I did the 2-year Treasury yield minus the average 2-year spread of Germany, UK, Japan, Canada, Swiss, Australia, and China sovereign bond. This is 2-year, a shorter term one that is much more sensitive to monetary policy. Okay, longer term yield is more sensitive to economic growth, inflationary trend, and we call it the fiscal policy implementation by the respective government. 2-year is more sensitive to the respective government monetary policy stances. So what we could see is that yesterday, the 2-year spread between the 2-year Treasury yield versus the rest of the world is still hovering at a level almost the same a week ago at 1.6%. You can look at my screen over here. All right, almost the same as a week ago. So nothing has really changed. That means market is still looking at the Fed to cut rates going forward in September. All right, despite that high volatile movement in the longer term tenure sovereign bond yield seen globally yesterday, which is the 30-year, caused by the spike in the 30-year UK gilt yield. All right. So if you look at the CME Fed Watch 2, market participants is not expecting the Fed to actually stand pat or even hike rates next month. So if you look at over here in the 7 September meeting, market participants in the Fed Funds futures market being compiled by the CME Fed Watch tool is looking at a high chance of 92% for the Fed to cut rates by 25 basis points to bring it down to 4% to 4.25%. Current rate is 4.25% to 4.5%, and they expect to another 25 basis point cut to bring it down to 4% to 4.25%. And that jump was an increase from a day ago. Right, yesterday was 86, jumped to 92%. A week ago was 87.8%. So there is still a high probability that the Fed may cut rates in the September FOMC meeting. So that could actually see another revival of dollar weakness coming into play, right? And if you were to look at the aggregated tab, means looking at the probability on the future FOMC meeting, market participants is still assigning a high chance of more than 60%, 77% that the Fed will potentially do another second interest rate cut before 2025 ends on the 10th of December 2025 meeting. FOMC meeting to bring the Fed funds rate down to 3.75% to 4%. And thereafter, if you look at next year, market participants is also continuing to see a gradual interest rate cut by the Fed. 65% chance on 28th of January 2026 to bring the Fed funds rate down by 25 basis points to 3.5%. And they are looking at the Fed funds rate to be at 3% to 3.25% in 2026. So there's a 61% chance right now, based on the current economic data that market participants has accessed. By the 9th of December 2026, 61% chance, pardon me, market participants expect the Fed funds rate to be lower at 3% to 3.25%. So that's close to around 1.25 percentage point lower than the current rate of 4.25% to 4.5%. So market participant is still expecting a dovish monetary policy going forward by the Fed, which means, i.e., dollar strength could yesterday's dollar strength was being unfounded. That means it could be just a spike up. Then thereafter, the longer term trend of the dollars could still be potentially remains weak over here. And if you look at the technical chart of the dollar index, it's also being supported by that. All right. So if you look at the dollar chart, the dollar index chart over here, so this dollar index charts, right, it starts to actually still trading a sideways range, a nasty sideways range, since this 52-week low on 1st of July, where it tested the key support level at 97.3. So this 97.3 very quickly, why is it important on the US dollar index? If you look at the 1-month chart, is in fact the long-term circular ascending channel support now at 97.3 that is in place since the low of May 2011. So a breakdown below 97.3, if we do have another monthly close below it, could signify the start of a major US dollar weakness. All right, so at this point in time, if you look at the daily time frame chart, it continues to be trapped in this nasty sideways range configuration. All right, over here. Okay, so the next resistance level to watch was a rejection level that got rejected since 5th of August. That means last month. Okay, last month, where price action shaped this bearish Marubozu. So this bearish Marubozu candlestick is very important. Why? Because it coincides with the release of the previous month, not this month, the previous July NFP lackluster reading that came in way below disappointment. Then thereafter, the dollar, whatever rebound, it fails to break above this 98.95 level. Okay, got rejected on 11th of August. And this level will be watched very closely by market participants upon the release of this Friday NFP data. Right, something to take note of. So what you could see over here is that based on the dollar index chart, there is also no clear signs of a major bottoming of the US dollar index, in line with the fundamental that I shared with you guys earlier on, that is still supporting rather longer term and medium term broad-based US dollar weakness. All right, so yesterday's, okay, now that's for the FX market. So yesterday's movement created a negative, yesterday movement on the spike up in the UK 30-year gilt yield also caused a spike up in the 30-year US Treasury bond yield. All right, so what do I mean by this? Okay, so markets are interrelated. So UK 30-year spike, it also created a spike up in the 30-year US Treasury yield as well. All right, so there's a spike up, but the spike up still remains below that 5.17 resistance level. That is the high that was printed in October 2023. But what's interesting over here is that the 2-year Treasury yield continues to inch downwards and looking to actually break that all important support of major support of 3.55. So this is the monthly chart. So if you look at the daily chart itself, okay, it still remained contained yesterday's level. Yeah, so despite there was a push up initially, then after that it ended with this long tail candlestick over here. And what's interesting over here is that market actually reacted to this near jerk reaction positively by the end of the US session yesterday. So what do I mean by that? If you look at the intraday chart of the S&P 500, initially there was a sell-off, right? So this sell-off, it came down to an intraday loss or a low of negative 1.15%. And upon hitting the close to the 12 a.m. mark Singapore time, we see a V-shaped rally where the markets actually close higher. All right, close higher, close higher. All right, over here. So I would say that there is some signs of positiveness that it came back into the US market yesterday that doesn't signify the start of a medium term and a major downtrend phase on the US stock market yet. Okay, because there is this mini V-shaped recovery that should take shape. And this mini V-shaped recovery causes the S&P 500 to trim its losses to end the session with negative 0.69%, the Nasdaq negative 0.8%, the Dow Jones Industrial Average fair much better, negative 0.55%, and most interestingly, the Russell 2000 closed almost unchanged. Why this Russell 2000 is very important to gauge the health of the US stock market is, don't forget, like I shared with you all earlier at the start of today's daily dose, yesterday's risk off is caused by risk off in global stock indices and the US stock market is caused by a spike in the longer term global sovereign bond yields, which is the 30-year UK gilt yield. Russell 2000, small cap company, their gearing ratio is much higher than companies in the S&P 500. Why? Because the small cap company doesn't have pricing power. So what they did over here, to some of them, to maintain their business operation, they need to have a higher gearing ratio. But higher gearing ratio, that means, i.e., if there's a spike up in longer term interest rate, this company will be badly hit. But why the Russell 2000 managed to find confidence towards the end of the US session and close almost unchanged is because there is still going to be what I call a Fed dovish pivot coming into play to actually address this spike up in this 30-year sovereign bond yield. That means the Fed potentially could provide an emergency backstop like what it did in the past to provide liquidity back into the market again. So that's explain why the Russell 2000 managed to close almost unchanged yesterday. From a technical perspective, it actually represents a bullish reversal, which means that the bullish trend on the market still remains intact, and I'm going to respect the price action from it. All right. So if you look at the price chart of the S&P 500, this is what I mean now. Okay, over here. Let me share with you guys, expand my screen. Okay, initially it dropped by negative 1.5%, but ended the session with a smaller losses at negative 0.69% and ended from a daily perspective, a daily bullish hammer candlestick. And this daily bullish candlestick formed at this significant low of 21st of August. All right, that is the day before Fed Chair Powell dovish speech at the Jackson Hole Symposium on the 22nd of August. Okay, very important. Same for the higher beta Nasdaq 100, which is driven by, a lot of people say that the AI optimism team play in the last 3 years, and some critics has now give rise to an AI bubble that is in play. it managed to form a bullish Marubozu candlestick, almost the same, a white candle, a significant long body white candle with very little shadow, and where it actually formed also on the 20th of August low, prior to Fed Chair Powell dovish speech at the Jackson Hole Symposium on the 2nd of August, and right exactly at the retest of that 50-day moving average, where price action has been trading above it on since 1st of May. And we know that AI team play, whether this AI team play is over, the way to monitor it will be the juggernaut NVIDIA. So let me share with you NVIDIA chart, which I shared previously as well. NVIDIA, interestingly, yesterday, initial sell-off managed to hold right exactly at my pivotal support that I mentioned earlier on before the earnings release. 167.90, bounce up, support came in, ended the session with a doji candlestick light, and right at the 50-day moving average as well. All right, so seems to us that this AI juggernaut NVIDIA managed to find support at the end of yesterday's volatile movement. Net overall is a positive, still positive for the US stock market, given this price element that I shared with you guys earlier on. All right, now before I move on to the second segment, very quickly, let me share with you what are the news data that has been released yesterday over here. So yesterday, what we could see is that the ISM manufacturing continues to be weak for the US, the PMI data. So market participants expecting it to be at 49. It came in at 48.7. So that also increases the chance that the Fed got to come in to provide that liquidity increase to the US economy by starting to actually restarting the interest rate cut cycle. And one thing interesting is that the manufacturing prices, so we know the ISM manufacturing PMI data, within it there's various subcomponent, and the subcomponent, the manufacturing prices is considered as a gauge of cost of doing the business, all right, in the manufacturing sector in US. So cost of doing manufacturing sector in US, prices still remains high at above the 50 level, but came in below expectation. Market is expecting at 65.3, so it came in at 63.7, below expectation and below the previous July print of 64.8. So it means that the cost of doing business in the manufacturing sector in the US is not as high as expected, and the cost has started to slow down slightly, which is kind of a positive as well. Okay. Then if we were to look at today's economic data release, which is the Australia Q2 GDP growth. So Australia Q2 GDP growth came in better than expected. So market is expecting 1.6, it came in at 1.8%, and that also causes the Aussie dollar to actually rise against the USD in today's Asia session. All right, indicating what I call the lesser a support that actually allows the RBA to actually be much more gradual in its interest rate cut approach. All right, so now with that, let us now straight away jump quickly to the intraday technical outlook, right, after yesterday's volatile movement. Okay, let me expand my screen. All right, so let us start with the FX market. Okay, over the FX market, let's start with the euro dollar. So the euro dollar, on Monday, we have that intraday technical outlook where I have my pivotal support still remains the same at 115.90, 115.70. So yesterday's price action, the initial sell-off managed to find some support at this minor ascending channel from the low of 1st of August 2025. So support level still remains unchanged at 115.90/115.70, but I will have a first intermediate resistance level to watch for today will be at the 1.1665 level. Okay, 1.1665 level, a breakout above 1.1665 level, which is a reintegration back above the 30-day moving average, will see a further potential impulses for this recovery scenario, minor recovery scenario to take shape, to retest that stubborn resistance level of 1.1730 that got 1.1730 that got rejected on Monday. However, a price action pushed down below 1.1560, 1.1570, pardon me, will invalidate today's bullish bias to kickstart a extension of the minor corrective decline sequence that has taken shape yesterday to expose the next near-term support level in first step at 115.30, which is the minor swing low area of 1st of August and 5th of August. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar continues to remain weak. So I'll be on a watch out for today on this further potential residual drop on the sterling dollar towards the medium-term pivotal support level or zone at 133.15, 132.80. Yes, we can still have a short-term intraday bearish bias, but I'm watching very closely to this 133.15, 132.30 because it confluences with various technical elements. One is the medium-term ascending trend line drawn from the low of 13th of January, congestion area here previously of 4th of August and 6th of August, and as well as the golden ratio retracement of the previous minor impulsive up move sequence from 1st of August to 14th of August at the 61.8% Fibo retracement. And given that the RSI yesterday has hit a extreme overbought level, so if it starts to see a price push down at 133.15 and we start to see a bullish divergence and thereafter a bullish reversal candlestick, then potentially this area here could be an inflection level for the sterling pound to shape a recovery going forward. All right, so something to take a look out for. So pivotal resistance for today will be at a 134.50 level. All right, so if suddenly a price action during the later part of the European session and US session hit this level and starts to reverse up and clear above 135.50, then potentially yesterday's minor corrective move has been eradicated to see some form of bullish momentum coming back into the sterling pound for the next resistance to actually be visited. To be visited will be at 135.45 that got rejected on Monday and previously got rejected previously on the 2 Fridays ago, which was ex-post Fed Chair Dovish speech at the Jackson Hole Symposium. Right, so that's for the sterling pound. However, if the sterling pound continues its decline towards 132.80, so if it start to break down below 132.80, which is very important, that could also create a negative feedback loop into other FX market as well, where we start to see the FX dollar strength starts to be much more pronounced even against the euro and against the rest of the currency. So looking sterling pound being the weakest link, that will be a benchmark or a signal to watch out for to gauge the health of to gauge the movement of the FX dollar in the shorter, the US dollar in the shorter term. So if you start to see a breakdown below 132.80, then the next support level to watch out for will be at 131.40. That means there will be further potential weakness on the sterling pound at 131.40, which is the minor swing low of 1st of August. All right, so that's for the sterling dollar. Next up, Aussie dollar. So the Aussie dollar, what we could see is that over here, yesterday it managed to find support at this minor ascending channel lower boundary that I draw from the low of 22nd of August. So overall, before I jump straight into this line, the Aussie dollar on a daily chart, right, it still continues to trade kind of a sideways within this expanding wedge range configuration that is still in place since 24th of April 2025 low, right? So this kind of expanding wedge range configuration over here. So on a shorter term basis, on the hourly chart, so today key pivotal support level to watch will be 64.70, 64.60 over here, which was this previous minor swing low area that found support since 24th of August before springboarding up higher towards the upper limit of this 65.60 that got that previously bulls got rejected on 13th of August and 14th of August. All right, so I'll be using 64.70, 64.60 as my short-term pivotal support level. A breakout above 65.25 potentially increase the chances of a minor bullish recovery scenario for it to revisit 65.60 of the Aussie dollar. However, if we start to see a breakdown below 64.60, pardon me, then potentially the Aussie dollar will see a further extension of this minor corrective decline towards the lower limit of this medium-term expanding wedge range configuration that I share with you on the daily chart. Next near-term support level to watch in first step will be at 64.30, which is the former minor swing high of 21st of August, and 22nd of August turns into a minor pullback support area at 64.30. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen yesterday spiked up in the early Asia session, which I shared with you yesterday, was due to that very conflicting public remarks made by BOJ deputy governor, the governor, that causes the dollar yen to spike, and it spiked further during the UK session or the European session after that spike up in that 30-year UK gilt that causes the weakness on the sterling dollar to have a negative feedback loop into the Japanese yen as well. So this Japanese yen over here now playing with the 20-day moving average. It hit the 20-day moving average, and as well as the minor swing high of 23rd of August. 22nd of August, pardon me. So with that, I'll have a neutrality stance right now. So neutral between 14875, 14895, and the 148 figure level, which was the previous our short-term pivotal resistance level, now turns into a critical pullback support on a very short-term basis. Why? Because of yesterday price action attempt to sell off, and it starts to shape a bounce during today's Asia session from it. Right, so neutral between these two levels, 148.75, 148.95, and 148 figure level. However, a breakout above 148.95 potentially could see a further squeeze up towards the next resistance level in short term at 149.70, 149.80, which is a Fibo clustering zone. Firstly will be the 1.236 Fibo extension taken from the low of 14th of August, and the 76.4 Fibo retracement of that previous decline from 1st of August to 14th of August. All right, so that's for the dollar yen. Quickly will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to hold above the 20-day moving average, which is our pivotal support level. So no change in terms of level. Price action in today's Asia session gap up, but can't clear above our first resistance level that we highlighted on Monday, 25,690. So still on the lookout for this potential recovery that may take shape on the Hong Kong 33, representing the Hang Seng Index, because it still continues to be held by this rising 20-day moving average, where price action yesterday during the US session dipped and did that V-shaped minor recovery. So still using the pivotal support level at 25,260 to maintain my bullish bias. First resistance you got to surpass for sure will be 25,690, given that this is also very important near-term resistance, given how price action rejected off it during the intraday session as we are speaking right now at the 9 a.m. Singapore time today. So a breakout above 25,690 will increase the odds of this bullish bias scenario for today to revisit the minor swing high area of 25th of August at 25,890 in first step. However, a bearish breakdown below 25,690 will invalidate today's bullish bias to see a further slide to revisit 25,050, maximum 24,880, which coincide with the rising 50-day moving average and the lower limit of this medium-term ascending channel that is still in play since 2nd of June 2025 low. So that will be the Hong Kong 33. Next up will be the Japan 225. So Japan 225 on Monday, representing the Nikkei 225, we flipped to a neutrality stance because of mixed elements. And very importantly, very interestingly, the hourly RSI now has started to shape a bullish divergence over here. There's a higher low, all right, from second yesterday, but price action yesterday shaped a lower low. All right, so with this bullish divergence that has been seen on the hourly RSI, indicating that yesterday's sell-off downside momentum has started to ease off. So I'll be using the lower limit of the neutrality zone as my pivotal support zone for today, 41,760, 41,550, flip to a bullish bias stance for a potential minor recovery. First resistance to watch will be at 42,520, which corresponds very closely to the 20-day moving average. Above this level will increase the odds of this bullish biasness for today to revisit 43,060 next, where bulls got rejected on 28th of August and 25th of August, which is also a next important near-term resistance level to watch for the Japan 225. However, a bearish breakdown below 41,540 will invalidate today's bullish bias recovery scenario to see the extension of this minor corrective decline to slide further to retest the medium-term pivotal support zone at 41,275/41,070, which confluence with the rising 50-day moving average. Moving on will be the Germany 30. So the German 30 representing the German DAX continues to slide down as intended, hit our support level at this 23,600 level yesterday. No signs of any we call it a double bottom formation over here, and also the price action remains negative, given the fact that right now there's a bearish reaction of this dotted red line here. What's this dotted red line? So this dotted red line is actually the former ascending channel support from the 19 June 2025 low, now turns into a pullback resistance level. All right, so given this negative price reaction on the Germany 30, I will still maintain that bearish bias on the Germany 30 using a tightened short-term pivotal resistance for today at 23,790, which implies that we may be now doing the fifth wave down move. All right, wave 1, 2, 3, 4, and the fifth wave. All right, so the fifth wave is a one-time Fibo extension to the downside. So if we do the 23% of the entire ongoing 5 wave down, the 23% is very close to this 23,790 level as well, which is a graphical resistance over here. So using a tightened short-term pivotal resistance level at 23,790, maintain that bearish bias for the Germany 30. Next support level to watch will be the one-time Fibo extension on the downside will be at 23,425. A breakdown below 23,425 may see further weakness towards 23,280 next, which is a 1.236 Fibo extension on the downside. And this 23,425 also confluence closely with the minor swing low of 1st of August. Only a bullish breakout above 23,790 will invalidate today's bearish bias on the Germany 30 to see a potential minor recovery to revisit the next resistance level in first step. Okay, there will be a higher level over here. It will be the former minor swing low of 29th of August. Now turns into a pullback resistance at 23,900. Okay, above 23,900, potentially see a further bounce towards the 20-day and the 50-day moving average, conferencing at the next resistance level at 24,155. All right, so next up over here will be the major US stock indices, starting with the Dow Jones Industrial Average, representing the Wall Street 30. So the Dow Jones Industrial Average managed to bounce off at our former all-time high area at 45,100, and also managed to shape a bounce right exactly at the 20-day moving average. So this is a zone. So I'll be using this zone 45,100, 44,900, which is a 20-day moving average, as my pivotal support zone for today, having a bullish bias for a potential recovery in first step. First resistance to watch will be at 45,455. So if we could surpass this 45,455, the recovery odds will increase to retest the current all-time high area at 45,780. However, a bearish breakdown below 4,900 will invalidate today's bullish recovery bias scenario to see a further slide towards the medium-term pivotal support area at 44,715, 44,500, which confluence with the rising 50-day moving average as well. Next up will be the SPX 500. So the SPX 500 managed to shape a bounce right above our pivotal support zone. This is the medium-term pivotal support zone, and also confluence with the rising 50-day moving average. So the bounce also takes shape right exactly at the lower boundary of this medium-term ascending channel that is still in place since 23rd of May 2025 low over here. So given the fact that the hourly RSI also start to shape a positive bullish momentum observation, where it starts to shape a bullish breakout from a former parallel descending trend line resistance. All right, indicating that yesterday's net bearish momentum potentially has starts to be eradicated over here. So using the pivotal support zone, which is the medium-term pivotal support zone at 6,370, 6,335, we saw the clear minor swing low area of 20th of August and the 2nd of August. We saw confluence with a very important risk event, which is Fed Chair Dovey's speech over at the Jackson Hole Symposium symposium, pardon me, a bit tongue twisting. First resistance level to watch 6,450. A clearance above 6,450 will increase the odds of this bullish bias recovery scenario to revisit 6,490, followed by the current all-time high area very close at 6,517. Only a bearish breakdown below 6,350 will invalidate today's bullish slash recovery bias scenario to see a further slide to revisit the next near-term support level, which is the minor swing low area of 6th of August and 7th of August at 6,320. Quickly will be the Nasdaq 100. So the Nasdaq 100 also managed to recover right at the 50-day moving average after a test of it yesterday, and right above our, right exactly at our pivotal, medium-term pivotal support area at 22,960/22,945, which is also the former pullback support of this former upper boundary of this long-term circular ascending channel from March 2022 low that got taken out previously on 4th of August. Right, now turns into a significant pullback support. Bullish slash recovery bias scenario on the Nasdaq 100 for today using 22,970/22,945 as my medium-term pivotal support level. First resistance 23,385. A breakout above 23,385 will increase the level to watch the odds of this bullish slip to retest 23,580 in first step. Above it, potentially seek out the minor 29th of August swing high at 23,750, where the bulls also got rejected on 19th of August. However, a bearish breakdown below 22,945 will invalidate today's bullish slash recovery scenario to see a further slide down to expose the next near-term support level at 22,670, 22,600 level, which is the minor swing low area of 1st of August and the congestion area of 8th of July and 14th of July. Next up will be the commodities market, starting with the bullish yellow metal, gold XAU/USD. So gold XAU/USD, yesterday it spiked up as expected, where we featured at our chart of the day, hit our resistance level, 3,436, 3,548 over here. So RSI now has really starts to exit from the overbought level. So potentially there could be a chance of a minor pullback taking shape. So I will tighten my pivotal support level from a risk management perspective to the former all-time high area where it got initially got kind of rejected earlier on yesterday before it did a bullish breakout. So now turns into a near-term significant psychological level to watch. So this will be my tighten short-term pivotal support level for today, 3,500, to maintain my bullish bias on gold XAU/USD. Next resistance level to watch will be 3,567, followed by 3,590, 3,600, which is a psychological level, and also confluence with a bunch of Fibo extension cluster levels. However, a bearish breakdown below 3,500 will negate today's bullish bias to kickstart a minor extension of the minor corrective pullback scenario, potentially revisiting 3,469, 3,451, which confluence with this minor ascending trend line that is still in place since the low of 22nd of August. Lastly will be the West Texas oil. So the West Texas oil yesterday got a spike up over here, retest the 50-day moving average, and now starts to actually come down off it. So the spike up in the West Texas oil was actually due to US imposed sanction targeting Iranian oil. All right, so that causes a short-term rebound in the West Texas oil yesterday. So given that it didn't actually clear past the 50-day moving average where that's got resisted over here, and the hourly RSI has started to shape a lower high as well. All right, over here. So I will have a neutral, I will flip to a neutrality stance for today. So neutral between 66.90 and 65 figure level. A breakdown below 65 figure level potentially may start to see some form of near-term bearish tone coming back into the West Texas oil. Next support level to watch in first step will be 64.80, which is the 20-day moving average, I think as a support level as well. A breakdown below 64.0.8, not 64.80, pardon me, 64.08 may open up scope for further weakness towards 63.30. All right, so that's sum up the intraday technical outlook on all the 12 broad-based cross asset classes. So before we go, let's take a quick look at the economic calendar. What are the key data to look out for today? So for today, we do have a key officials, key central bank officials speaking, starting with 3:30 p.m. ECB President Lagarde speech, and as well as a Bank of England official man speech. So market participants will be hearing very closely, especially from BOE. Is there any address or concern regarding about that spike up in that 30-year gilt yesterday? Yield yesterday. So that will be 3:30 p.m. Singapore time. Then at 4 p.m. Singapore time today, we will at 3:30 p.m. Singapore time today, ECB President Lagarde and Bank of England man speaking. And then 4 p.m. Singapore time today, RBA Governor Bullock will be speaking. That could potentially influence the Aussie dollar and the Aussie crosses. Then thereafter, another BOE official speaking, BOE Brandon. Breeden will be at 4:15 p.m. Singapore time. All right. Then follow. There will be a quiet session. Then what we have is that we have a tier 2 labor market, US labor market data to take note of. 10 p.m. Singapore time, the job openings data for the month of July that could influence the major dollar pair and the major US stock indices. And thereafter, there will be a quiet US session followed by a US federal official speaking, Fed Kaskagri at 1:30 a.m. Singapore time on Thursday. And right into the Asia session tomorrow, before the start of our daily dose, we have Australia balance of trade data, which is the trade data for the month of July, 9:30 a.m. That could influence the movement of the Aussie dollar and the Aussie crosses. So that sum up today's daily dose of market insights will be a bit longer. Why? Because of yesterday's volatile movement in the global markets yesterday, which I hope that today's insights will enable you guys to gain a better ongoing view and situation in the global markets and things to take note of going forward, especially the key levels on the shorter term basis. So with that, I'm Kelvin here signing off. Have a great day ahead, and we shall speak again tomorrow. Thank you.